Recently, I was listening to a podcast where Grant Cardone was discussing taxes and real estate. At one point, he said something that made me completely stop what I was doing. I was actually on a treadmill and think. So basically, in a nutshell, this was the point he was trying to make. During your lifetime, the biggest expense is going to be what? Taxes, right? As typically the more that you make, the higher your tax bill. Now, what made me stop the treadmill was this question he posed. If somebody were to spend only 6 to 12 months on educating themselves on something that they know for a fact is going to negatively affect their finances over their entire career, what do you think that would do to their future wealth? Now, sometimes it's the smallest things that can make the biggest difference. And in this video, we're going to get into a tax strategy that, if used properly, can allow you to pay little to no taxes over the entire course of your career. As a disclaimer, my name is Dr. Jeff Anzalone. I'm actually a periodontist, not a CPA. Please don't accept what we're going to discuss in this video as tax advice. Consult your own personal CPA, but I do want you to download the free passive income guide I've put together for you below the video. Here's something to me that's pretty sad. I spent 4 years of college, 4 years of dental school, and 4 years of residency, yet received zero on learning about how money and how the tax system work. Now, I want you to, for a minute, just to think about our education system on a larger scale. So it seems that the longer that we're in training, the longer that we're in school, the better our chances are to have a high income, right? Now, what typically goes along with this? High income equals high tax bill. So you go to school, you take out loans just to get by, you delay all this gratification because you're putting all these years in. And then if you choose a white collar profession, it forces you to start out in the real world much later than most people. I didn't start practicing until I was 31, while most of my friends got out, they were 22, 23 years old. Well, that's a big difference. So I want you to think about how our education system is set up for a minute. It's actually set up to put us, you guessed it, in the rat race from day one, especially if you're a doctor or other high-income professional. If you don't learn how to lower your tax rate each year, then you're going to do what everybody else does. You're going to work for 40 or more years. You're going to take forever to pay off your debt. You're going to follow the accumulation method via 401k. You're going to pay 6 to probably 7 figures in taxes over your entire career, and you're going to be stuck in the rat race with no early way out. I'm going to get off my soapbox now, and I'm going to tie all of this that we're talking about into our main topic in this video. The majority of millionaires invest in real estate not only to acquire recurring income, but also the unique tax benefits. And one of the most significant tax benefits of owning rental property is something called depreciation that can be used to reduce taxable income, which leads us into an even larger tax benefit, and that is accelerated depreciation. Now, before we get into exactly how this accelerated depreciation process works, let's first start off with the basics so you should know regarding depreciation. And our first question that we're going to discuss is, what exactly is depreciation? Now, depreciation is one of the rare gifts that the IRS gives us taxpayers. Yes, they do give us a gift. It's actually a unique tax strategy that allows you to write off the value of an asset over a period of time. So just like most things that lose value over time, like the computer that I'm talking on, your cell phone, the IRS actually allows a deduction for that declining value, which is called depreciation. Here's the cool thing about a real estate investment. Even though it actually appreciates in value over time, right? The IRS still allows us to claim this declining value or depreciation benefit. All right, so there's two main types. First one is straight line depreciation. And whenever somebody mentions depreciation, basic depreciation, this is what they're typically talking about. Now, by using this method, the IRS allows owners of residential real estate, people are renting out property from you, to depreciate their property over a period of 27 and a half years. So here's an example. Dr. L, he purchases a property, and it's actually has a value of $2.75 million, excluding the land costs because land can't be depreciated, okay? So in this case, if you take 2.75 million, you divide it by 27 and a half years, it will give him it would actually yield him $100,000 in depreciation per year over the next 27 and a half years. Okay, and that's how we get the calculation. Pretty simple, right? But who wants to wait 27 and a half years to benefit, right? Well, the good news is there's something that we can actually do to speed up, or you guessed it, accelerate the depreciation time period, aka accelerated depreciation. Okay, so again, if you don't want to wait 27 and a half years to reap this benefit, the IRS actually allows you to accelerate this depreciation via something called a cost segregation study. Now, accelerated depreciation allows items to be depreciated over shorter time schedules over 5, 7, or 15 years. Now, what they do, the reason why is it allows you to do this is they'll go in and they'll identify all of the non-structural elements of the property along with any of the land improvements. And we're going to talk about this in more detail when we discuss cost segregation study. So by doing this, this creates larger paper losses in the early years the property is owned, which has the effect of giving the investor more depreciation benefit up front. This is especially good for people like me. And then if you're a passive investor that is investing in real estate syndications, because a lot of these investments, they're typically held over 5, 7, or 10 years. Well, if you can accelerate this depreciation up front, you're able to reap all the benefits. So now that you understand that depreciation can be accelerated, again, let's discuss this process of how this can be accomplished with a cost segregation study. This is a very powerful tool that allows those who've constructed, purchased, or remodeled any type of real estate to increase cash flow by accelerating depreciation schedules, thus deferring income taxes. Now, this particular study, it actually identifies and reclassifies personal property assets to shorten the depreciation time for taxation purposes, which reduces your current income tax obligations. In other words, this study is going to go in, it's going to segregate out the different costs of a building. So if you have a particular building, let's say you have an apartment building, instead of taking that apartment building and dividing it into two main components, the land and the building, whenever you do this study, it can actually be broken out into four components: the land, the building, personal property, and land improvements. Now, personal property are the non-permanently affixed items to the building that do not relate to the overall operation and maintenance of the building. And you may be wondering, well, what are some of these things? Well, carpet, cabinets, drapes, security system, lighting, fixtures. Again, these are the non-permanently affixed items to the building that don't relate to the overall operation and maintenance of the building. Now, these items are now, once you have this study, they're now able to become depreciated over their useful life over typically 5 to 7 years. And 5 to 7 years rather than the typical 27 and a half years from straight line depreciation. Now, land improvements include items located outside a building that are affixed to the land and do not relate, again, to the overall operation and maintenance of the building. So these could be parking lot improvements, putting in curbs, putting in driveways. If you have an apartment complex or rental house, if you put in a pool, if you update a pool, if you put in landscaping, sidewalks, those types of things. So instead of the 27 and a half years, typically land improvements, they'll allow you to accelerate it for 15 years. Now, the primary goal is to identify all the costs that can be depreciated over a shorter life tax life. Typically, remember, 5, 7, or 15 years versus the building. So typically residential occupied can be, again, depreciated over 27 and a half years. Commercial property is 39 years. So reducing these tax lives results in three main things: accelerated depreciation deductions, a reduced tax liability, which is nice for you, and it increases your cash flow. Now remember, depreciation deductions, they only count the value of the building and not the land. Now that you know basically the concept of depreciation, straight line depreciation, an overview of accelerated depreciation and how we accomplish this with the cost segregation, let's bring all this together and let's talk about an example, okay? So we got Dr. A. Now, Dr. A, he wants to exit the rat race, and he actually goes out and he purchases an apartment building, okay? He purchases an apartment building for $3.5 million, and it actually is already cash flowing. There's already tenants there, and it's cash flowing, and the net operating income, so that's all the gross income minus the expenses, is the net operating income, or the NOI. $3.5 million purchase price, NOI is $200,000. And they figured out that the land is actually worth $750,000. Okay. Remember that land can't be depreciated. So he's now left with $2.75 million. So you take the $3.5 million, you subtract out the land. That's how we get that. All right. So now that's what the apartment is, and it actually can be broken up into the personal property land improvements, which is $300,000 personal property, $250 in land improvements. Okay. Now, if you take the $2.75 million and you subtract both of these, the $300,000 personal property, the $250 land improvements, the $2.2 million is what the building is now worth. Okay. Now, if he only were to use straight line depreciation, he'd be able to write off $80,000 a year. And the way that we get that is you take the 2.2 million, you divide it by, remember, the 27.5 years, you get $80,000. Okay. Well, he actually goes out and he obtains a cost segregation study, which allows this. The personal property, remember, was $300,000 here. Now he can accelerate that depreciation over a 5-year period. So you take the $300,000 divided by 5, $60,000. The land improvements, remember, 15 years, divide that by 15, $16,660. So Dr. A can now depreciate $60,000 over the next 5 years. That's his personal property, and he can now depreciate $16,670 over the next 15 years. Okay, that's the land improvement. Thus, the total depreciation is this. You take the $80,000, you take the $60,000, and you take the $16,670, you add all that together, okay? You add all that together, and you get $156,670. That's the total depreciation. Now, you take your net operating income, that's what the building is producing, right? That's what's left over, that's what's put in your pocket. So instead of him having to pay taxes on the $200,000, he's now only taxed on the $200,000 minus this total depreciation, $156,670. You subtract the two, he's now only taxed on $43,330. Now, he's a doctor. Let's assume that he's in a 37% tax bracket. So his tax with accelerated depreciation is this. You take the 43,330, you multiply it by this 37% tax bracket, and guess what? That is what he's actually going to have to pay. That's on his tax bill, $16,032. Now, I hope you're starting to see how adding rental properties to your portfolio can be dramatically used to grow your wealth. Now, let me leave you with this. The most significant advantage of accelerated depreciation is actually the reduction in your net taxable income. Paper losses that are created by depreciation can be used to offset other things as well, not just real estate, within the same tax year. So let's say you have net income from another rental property. Let's say you've sold some dividend income producing stock. You have some dividend income from a stock or a mutual fund, something like that. This depreciation, again, if you do it in the same year, it can help offset those taxes. Here's the kicker, though. This is not one of those, if you have to use it or lose it strategy. Any of the remaining losses that you have, any excess depreciation, if you've got $200,000 in depreciation and you only use $100,000 of it this year, you don't lose the other $100,000. You can actually carry it forward into future years to thus help offset future gains. Besides the extra streams of cash flow to help reduce my dental income, real estate syndications have also allowed me to help reduce our tax liabilities by using this accelerated depreciation. Now, before you start the investment process, make sure that you've got a knowledgeable real estate CPA on your team, and consider joining my personal passive investor circle. It's free, but it's for accredited investors only. And I've actually put a link below this video as well. And speaking of real estate syndications, what I want you to do now is check out this video over here where I break down step by step how you can get paid investing in syndications. We're going to talk about what's a waterfall calculation in syndications over here. See you there.